2, 3, draw.
We'll see you around the timeline. Feels good to be back.
I think that Rollup is one of the most premier media brands in crypto, and I love listening to them. I think Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity, the entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top. We're on 4th floor today. We're gonna be on floor 1, and then we're heading straight to the moon, boys.
Rollup is my favorite.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the Nest. See you on the show.
Yes, sir. It's day 2 from the Nest, live from the Tokenization Tower, the home of Neo Finance.
The Rollup live from the Empire State Building.
First guest today.
Welcome to day 2.
Pretty stoked. Guys, we got to give a shout out to our boys at Plume. The Nest wouldn't be possible without the Plume team. They are actually absolutely cooking with their Nest RWA Vault product.
Yeah.
Brings you the best yields off-chain, on-chain. Does a lot for you with their Nest product and Plume, the RWA chain as well. Guys, we're live, day 2 here.
And RWAs are a flagship of our Neo Finance thesis and everything that we have happening in New York, in the Empire State Building with Neo Finance, tokenization, and digital assets.
Yep.
I'm pretty excited because we have our first guest today.
Good, man.
I think we just entered the building.
Good, man. Well, we got today's topics coming up. We've got a full list of suite of topics from news to the state of affairs with Canton Network and more. Yeah, guys.
We have about 15 minutes here before our first guest is going to join the show. Why don't we cut to our first segment?
There we go.
Get started here.
Alrighty, guys. Man, yep. Yesterday was the first show here. We had so much production work go down the last couple of days. I mean, it's been a 48 hours of a journey. We're here again in the Empire State Building where the leaders of digital assets and finance converge. It's a beautiful day here. Guys, let's get rolling in.
You know, yesterday we were talking...
Before we start, guys, Plume, one more time. The on-chain asset manager that you all need. Shout out to Plume. Check them out. Check out Plume. Again, guys, thank you so much for being a part of the show here today.
So we're talking about the Nest Day 2. Obviously, Plume is instrumental in shaping the Nest. They've been our launch partners of this office in the Empire State Building. And they are part of the Neo Finance thesis about bringing high-quality assets on-chain, putting those into DeFi mechanisms, and ultimately having a more efficient, more robust system for finance. I want to ask you about day 1. How do you think day 1 went?
Yeah, it was amazing. I mean, we had our regime shift conversation here that really kind of laid the groundwork for what's coming in the future of this industry, of our show. Really was able to bring insights there that we have had and that we've been fostering for a while. And so it was very happy to be able to have that conversation open publicly and kind of move through it. We've got markets and weather today to cruise through. We've got timeline reactions, news, and yeah, we've got the Canton co-founder joining the show. Shout out to Powered by Trezor. Shout out to Trezor, one of the best hardware wallets in the game, powering our topics. Today's topics by Trezor. Yeah, we're gonna get right into it. It's another warm day in New York. I mean, come on.
You called it a slicker earlier.
Slicker beauty, baby. Let's go over. Here we go. Before we get into the weather, let me tell you about Frax. Frax is the leader in stablecoins, the future of digital money. FRX USD is live. Check them out at frax.com. Yeah. Guys, it is a freaking slicker beauty today in New York City. We're getting 74 degrees on the thermometer. I mean, it feels warm. I mean, it's shorts and t-shirts weather out. Powered by Relay, some of the best cross-chain swaps in the entire ecosystem. A little bit of wind today. We got the fan in here cooking. Yeah, this is not a normal March after the brutal February.
Stand by snow. Push back the launch of the Nest just a little bit. And now I'm glad that we did because now we have some beautiful weather that we've been fortunate enough to launch with. Look, day 1 yesterday was incredible. Obviously, the Nest launch pumped the market. We literally, almost said that, the war has basically ended as a result. Oil came crashing down.
Oil did nuke.
Gas is coming down. Hyperliquid is up. The
market's
up.
Let's check the markets.
So let's go ahead and check it out.
Yep. We got another green day here today, guys. Bitcoin sitting at 70,782, up quite a bit on the day. Ethereum sitting at 2071, back above that 2K mark. Solana just barely holding that $75 support. Chainlink and Near also up.
We are going to announce here today, Chainlink is our sponsor for the DC Blockchain Summit. And so we're extremely excited about this because DC is somewhere where a lot of action is happening. There's plenty of things that are coming up from DC. We expect lots of announcements that are going to be coming out. Michael Seelig, Hester Peirce, who has been on the show. These are people that are doing extremely big things in DC. They're fans of crypto. They're fans of the entire digital asset convergence and evolution that we're seeing take place. And we're extremely fortunate and grateful to Chainlink for partnering with us in the DC Blockchain Summit. Also, shout out to the Digital Chamber themselves.
Yep.
Big fans of the Digital Chamber and all the work that they've been up to. over the
Guys, I got something for you today. We're green. We got some bear spray. We're just gonna exterminate bears all year long here in the nest. If you guys are watching, go ahead and go out there, get yourself a can of bear spray.
That is a real can of bear spray.
That is a legitimate real can of bear spray.
If you're a bear, you should be.
We don't really support bears around here. I mean, we'll see how this next couple months shake up, but yeah, this is outdoor safety, self-defense, and everyone needs a little self-defense against bears. So, guys, this is Bear Spray, officially sponsored by the Rollup, and of course by Zama, who's powering our crypto prices, digital assets market today. So, guys, that's what's going on in the market. And we're bullish. As you said, oil prices came down quite a bit.
Prices are down. Hyperliquid was first to discover price sentiment around oil.
Yep.
We saw that happening on the weekends. Also, as markets are closed in the traditional world, we're seeing Hyperliquid capture price discovery as the venue of choice for oil traders. And generally, Hyperliquid is doing quite well. And so, man, there's a lot to be excited about, which is why if you're taking a look at what's around here, you don't need to be worried about the bear spray because you shouldn't be bearish.
Bears are done. All right, guys, that's the market for today. We actually have our first guest, Eric. He's in the studio. We're gonna rip through some of the news. Then we're gonna get Eric up on the show. And yeah, let's keep this thing rolling.
Let's do it.
Before we do, let me tell you about Near.ai, the blockchain for AI. Ironclaw is the private self-hosted version of OpenClaw. Check it out at Near.ai. You guys can try out Ironclaw yourself. Near is the blockchain for AI. And guys, as I said, we've got quite a few news topics to cover today. Starting off with privacy for Bitcoin, Starknet rolled out a STRK20 announcement, which allows privacy embedded ERC20s. So again, as we just talked about with Zama, who powers our digital assets market pricing, Starknet has just launched something quite similar. It is now, the market is now one click away from privacy. We spoke about this yesterday, Rob. We need privacy on chain. We need it to have this kind of next leg of institutional adoption. Privacy is very important.
Well, we're going to hear a lot more from our first guest about how institutional privacy can work and why it's so important to these institutions.
Yeah.
We said yesterday about how banks don't like sharing their depositors' information with other banks. Blockchain is inherently a more public place than some people may realize.
Yep.
Token standards are extremely important, especially as we're embedding privacy into the chain itself and into the asset layer.
Yep.
Remember, part of the neo-finance thesis is also having an asset-centric view of the world, right? We've been part of the rise of DeFi protocols and chains. Usually you have a chain. First thing you get is you get a lending protocol.
Yep.
You get a decentralized exchange. Maybe you get a yield aggregator or vault protocol on that chain. Now we're seeing those primitives at the asset layer. And that is causing us to take on a more asset-centric view of the world, which means these token standards or these asset standards are becoming increasingly important, especially as we add in more token primitives like privacy deeper into the protocol itself. Shout out to Starknet for doing exactly this, listening to the market and embedding privacy deep into the stack. Canton also doing good work on the privacy side, especially for institutions. We're going to be speaking with the co-founder of Canton in a bit. Before we do,
yeah, I mean, just something to add real quick on this. I think this like privacy and anonymous swaps is going to be something that they're really trying to kind of pioneer here. Really the idea here is that if you're a whale, you don't want to have your transactions shown publicly. I mean, I think this is like pretty important from the Starknet perspective. So, guys, shout out to them, and we'll keep it rolling. We thought this was cool, newsworthy. Up next is something pretty interesting. Paolo Ordino put out this article about this AI augmented BCI system decoding neural signals to text with 98.3 accuracy for speech impaired patients. So imagine you're a patient who, you're mute or you can't properly function from the speech perspective. Tether is now taking a $200 million majority stake in BlackRock Neurotech. The use case is targeting ALS and paralysis patients, enabling communication through brain signal decoding.
And as you guys have probably heard, we talked about this at our NearCon San Francisco live stream. Multiple companies are working on this sort of technology. It's almost part of the telepathy complex, where we're trying to read the brainwaves themselves, communicate those into natural language. You can ultimately use those for a variety of things like prompting AI. We talked about how Alter Ego is the company that launched this. It kind of looks like these earbuds that fit into your ears. They go on your temples, and then all of a sudden you can communicate with people without ever speaking words. This is obviously going to start with medical research, where we saw Neuralink, but there's all kinds of emerging technologies that
Yes, sir.
is seeking investment, and Paolo Ordino is there to do exactly that.
Guys, we're gonna take a quick break. We've got Eric here. We're gonna get him set up, get things dialed in. We'll be right back in just a second. Alrighty, guys, we're back here. We've got Eric Saraniecki in the office, in the nest, in the tokenization tower. We're going to be talking about the rise of institutional blockchains, Canton. It's going to get fiery. It's going to get spicy. Eric, you're the first ever guest on the show.
Truly honored.
In the office. You're live on air now. Welcome to the tokenization tower.
Thank you very much for having me. This is exciting.
Yeah, man.
Absolutely, man. It's been a long time coming, but we're excited to have you. And you guys are doing some great work in the space, so we're excited to chat. Maybe you can just tell us a little bit about yourself. First off, what is some of your background and generally how you ended up with Canton Network?
Yeah, sure. So I'm one of the co-founders of Digital Asset. I've been doing this 12 years. Prior to that, I spent about a decade at DRW. I got to join DRW super early, like down in the pits, paper sheets, fist fights, sort of a thing. I was like that University of Chicago football fraternity guy. So I could do math in my head, but I can get in a fist fight at the same time. It was kind of like right place and time for me to go into the pits. And I've been in Bitcoin since 2010, and I helped start Cumberland with one of the original pizza transaction guys. So just kind of like, I've been lucky enough to have a group around me of people that have been super early into the space, and I just, kind of been very, very active in it. And we had kind of a dual mandate in Cumberland, which was market make and provide liquidity, which would bring more institutional demand, but also invest in the things that we thought was missing or build the company if it didn't exist. And really that was the origin story of Digital Asset. Was we were looking for things that were really going to bring institutions into the space to adopt and use these ecosystems, not just speculate on them. And we didn't really see anything that was taking that seriously. And that goes all the way back to late 2013, early 2014, formally incorporated DA in 14 and left DRW for that not that long after.
So how did you find Bitcoin early on?
Yeah, I've been asked this a few times, and like my actual memories are a little bit later than when I actually got started. I will jokingly say something like, oh, well, you could buy drugs with it online. But the Silk Road was 2011.
Right.
But I'm trying to remember where I got in a little bit earlier. I think it just had to do with some like very early street transactions and kind of doing cash swaps for Bitcoin. I stopped doing that once I saw the source of some of these Bitcoins. But, I think it had a lot to do with that peer group that I had at DRW and some of the people that were very early. It was just kind of in the zeitgeist somehow over there.
Yeah. So on our first episode here in the nest, it was yesterday. It was just Rob and I, and we were talking a lot about how there's a regime shift ongoing in the space, right? We are seeing the rise of the professional. We're seeing the institutions come on board. We're seeing just this general shift in terms of token structures, equity structures, how people are positioning their brands, all of that. Canton has obviously been, it's been at least 3 years that you guys have been creating this entity and this blockchain. You guys have seen this coming. What is this regime shift from your perspective? How would you describe this kind of maturation and growing up phase that the industry is currently in? What's going to be gone? What's here to stay? Like, what are we gonna, what are our do's and don'ts?
Yeah. Okay. Well, I mean, not to disagree with my gracious host to begin with, but I don't really agree with the sea shift. I mean, I think that it's more kind of a growing awareness more than a shift. Like going back to the Cumberland days when we started this thing, the Cumberland thing, I didn't start anything else. Those are institutions. Those are really big firms. The people that are trading this for size are really big firms. You look at what Binance and Coinbase and OKX have become, they are huge firms. These are institutions by every definition of the word. And, so if I agreed with the premise, what I would say is that the children grew up and became really valuable. But I think that it's always been the undercurrent from the beginning. I've personally rejected this sort of it's peer-to-peer, censorship-resistant, decentralization, disintermediation. That narrative has never resonated with me. Probably to my own financial detriment, because I've never been as sort of like psychologically committed to this, like these other ecosystems. And I've spent, 12 years, along with many other people building Digital Asset in Canton. So like that's really where my passion and focus has been most of that time. But I think it's more, the space has been very young. I won't use like negative words like juvenile or fucking childish, but it has been for a very long time. And they're getting kind of squeezed out by, well, the next era of evolution is much larger scale, and that is driven by different participants, generally speaking. And they have a different set of requirements. And so just kind of everybody waking up to that And even if it's yourself, I mean, think about if you're a Bitcoin OG and you're getting, threatened of being kidnapped in Paris right now. Like it's a very visceral, real moment of something that you've probably thought about a lot, but suddenly became very real. And that's partially driven by the global awareness. I mean, look out your window. Everybody here knows what Bitcoin is now. So like that sort of general global awareness, people understanding how they can start to attack it, what it means for individuals, all that sort of stuff is kind of coming together at the same time. So I think it's mostly just everybody waking up to what they already knew.
And so you're saying the institutions were kind of already here.
Yeah.
Everyone's sort of waking up to that. You see Bitcoin as sort of just another asset class.
Yeah.
Nothing like truly groundbreaking in a certain sense. Nothing. It is, it's groundbreaking in the sense that you have this distributed ledger technology. Maybe that's a bit more groundbreaking. But as an asset class, it's an alternative currency. We have gold, right? We have these sorts of things. What is the mandate that you set out for digital asset in Canton? Given the thesis that you already explained, right? We kind of have this opportunity to work through the emergence of this new asset class with new technology. What was the value that you saw it could provide early on? And how did you set out to support that with Canton?
I mean, I sometimes say this as like, we're the last industry where when I click the button in my phone, it doesn't actually happen.
Yeah.
I think about every other thing in the past decade that has completely changed around, the phone in my pocket, yet somehow finance still. And that's true whether you're trading, you're moving money, like the front end of everything has moved unbelievably fast, but the back end hasn't budged an inch. And, there's a lot of entrenched reasons for that, but it's always been trying to close that gap because sometimes it does actually happen for you when you click the button, but the way that happened is someone used their balance sheet or someone plugged a hole with risk capital or someone is extending some credit at the last mile to make that happen. And so it's not that these experiences aren't creatable, but they're not really scalable. And when you like zoom out, it's almost mind-blowing how much capital sits in the system to just kind of hedge these risks. And I always think about the latency of the system and the capital that sits there as being a tax on humanity. And it's not really accretive to anybody. There isn't anyone like absolutely printing money because of these latencies. Like generally, if you're one of these intermediaries, it's your balance sheet that you're putting up front to kind of help facilitate this. So it's not really to a lot of people's benefit that it's happening. It is a general tax. And that's what kind of sets the scene that it's actually possible to fix the problem because you're not fighting against a lot of entrenched interests. You have other incentive and cold start problems, but you don't really have like activist people against it. Like sometimes in healthcare space, we spent a lot of time looking at the healthcare space early on. Often the entity that has the capital to fix the problem benefits from the problem. And so it's like a non-starter. But in capital markets, generally speaking, the problems in this system are that we already live in a distributed ledger, but our protocol for consistency is reconciliation. And we have an opportunity to upgrade that into something that's actually a real-time reconciliation system.
Yeah, and that's part of why I think we feel like this technology is inevitable. Not the asset class, but the technology itself is sort of a net positive win-win for everyone that tends to adopt it, and more so as more people adopt it, as network effects and liquidity start to build on these networks. Would you agree with that sentiment? Do you think that it's essentially a no-brainer? Tokenization, digital assets, lower settlement times, greater understanding of where the risk lies at any given point. Ultimately, this is a benefit to all of the institutions that tend to adopt this technology.
I would have agreed with you 5 years ago, but I think that again, we've been in this 12 years. This is probably my third or fourth sort of corporate blockchain cycle that I've lived through, and they've all failed. To be clear, we are definitively not one. But I've seen a number of these corporate blockchain cycles come and go. And for me, what I find so compelling about all these public networks, to be spicy, the tech is often really quite poor. I mean, maybe not the actual implementation, but like the design. We're going to be the network for the world, but we're one singleton, vertically constrained system. Like it's just kind of like very naive. But the tokenomics are really interesting because you have these cold start problems in any network that, like, can you name the first 10 apps that came into the internet? There are only first mover disadvantages in some of these networks. If you're going to be the adopter, you're going to be the builder, you're dealing with the worst version of the tech, you're dealing with an ecosystem that doesn't have users yet. You don't have the asset you want to interact with yet. Like, so creating a financial layer of first mover advantages where technologically there are only disadvantages, I think is something that you really have to embrace. And it was something that we did quite thoughtfully as part of the Canton network. Like, it was just tech for a long time to make sure we really ironed out, like, can the tech meet the actual requirements of the users? Are there no obvious reasons to veto this or prevent us from using it, or, you know, like all that sort of stuff. So just when there's not a lot at stake other than kind of a pure tech vendor system, like really iron that design out.
Yeah.
And that was the first, 5 to 7 years of our lives. But then, for more than the past 3 years, probably the better part of the last 4 and change has really been about designing the tokenomics and refining the tokenomics. And that's where I think that the combination of the two is what will win. One without the other, I don't think has much of a place. And it's easy to just say it's just the tech. But, to be quite empathetic to these institutions, if I am someone that runs a business at a large institution, I'm getting P&L'd and paid annually. And if I have to make a 3 or a 4 year sort of tech bet, that's hard to do without something like it just, I'm going to take on costs and I'm going to take on risk to eventually remove cost and risk is a very difficult calculus given the incentive structures inside the institution. So you have to kind of recognize that and meet that where it is and create an incentive structure that matches their incentive structure. And aligned incentives is at so many layers of the stack. It's not just, like Hype where we burn all the fees, or like in Canton, we burn all the fees. It's not just at that layer. You have to think about, well, who's getting them? Where is it being distributed? Who's earning it? What can they do with it? There's so many elements to it, and we learn more every single day.
Yeah. I mean, it seems so, right? You guys are collaborating with, JP Morgan, DTCC, a lot of these institutional folks at scale. And this is aligned with this kind of ongoing current gap in sentiment, right? Where you've got these kind of crypto Twitter token bear market ongoing, where there's this, on the other side, you've got this kind of institutional scale tokenization, stable coins. Everyone's running a POC for a blockchain or some sort of application. You guys seem to actually have the same positioning right now from a brand perspective. It seems like institutions love you guys. JP Morgan, DTCC on the validator side, on the on that kind of side, and then on the retail sentiment side, people on Twitter and across kind of conversations, they're like, is Canton a blockchain? What is it? It's private. It's a black box. You have no idea what it even is. Who's running this thing? Is there any censorship resistance? And so you've got this really interesting place to be. What do you have to say to that? Like
you earlier said that Canton is not a corporate chain. You've gone through,
but that is for sure what they would kind of box you in as. What do you have to say to the position of Canton with regards to this kind of gap in sentiment at large in the industry? Why does crypto Twitter hate you guys?
I mean, look, I'll give you a good faith answer, but let me give you a shitty, spicy answer first. It's because they're looking in the mirror and they realize the emperor has no fucking clothes.
Okay.
They're holding something that they can't actually explain the path to delivering the vision that they've been sold. And it's a scary thing to do. Like, it's tough to put your own money, your own personality, your own identity into something, which is what these communities have all been great at. It's like sucking up all this sentiment and interest and, gee, whatever you're on, like screaming it every morning on Twitter. Like that's an incredible thing. But then at some point, there's got to be some substance there, right? And a lot of these things don't really have substance. There's so little creativity or iteration over the original idea. Even ETH, which I think has produced an outrageously different outcome to Bitcoin, the design decisions are almost identical.
Yeah.
Almost identical. And I lived through a period, so the way I tell it is not necessarily the way that they felt it or they believe it or any of that sort of stuff. But from my perspective, as a very early Bitcoiner, a Bitcoin maxi, it was always Bitcoin plus smart contracts. And it was proof of work. And it was like, we're going to have sound money, but with programmability. They found product market fit in a very different zone. They found it in DeFi.
Yeah.
But then none of their incentives, none of their design, none of their structure, none of how they think about the network, none of that is built for DeFi. And then downstream of ETH, it's, well, how can we compete over consensus mechanisms? Because it was slow and expensive for a short period of time. There is so little experimentation outside of it. I'm so pumped. I know you guys are hype boys, but I fucking love hype. I think hype is great because it's like, hey, Base is completely centralized, so why can't we do the same thing and just kind of, but actually provide value and focus on value and drop some of this religiousness and so it's so interesting to me that where people apply their religious filter And it's very clearly being applied to us where it isn't being applied in other ecosystems, or maybe you've lived through it a little bit more directly in the hype world where it was probably being religiously hit over the head too for a while until the value was so overwhelmingly obvious that they couldn't ignore it any longer. And I think that the things that will stand the test of time and already have are the things that are pragmatic and deliver value to the user, which is not I don't think that's a hot take at all. Like, why does almost everybody access the network through Binance and OKX and Coinbase or Fireblocks or, MetaMask? I mean, these are all directly intermediated experiences through an institution. Why do they dominate? Because they provide real value to the user. And like they do every day, they get better at those things every single day. Yeah. So I get it. Like there's this kind of, I'm holding a bag on something that I don't know how to justify why it should be worth more. Yeah. And that game is kind of shifting very quickly under people's feet. And, we may or may not stand the test of time, but, I believe that we have a very differentiated and thoughtful alternative to what you might already have in your bag.
Yeah, I mean, we were talking about the evolution of kind of the structure of tokens as of this new administration, post Hyperliquid. Obviously, we love that, but we were talking about how the pendulum has shifted so far into the direct calculation of what your revenue is right now, and doing PDE ratios and really a lot of like very short term oriented financial modeling. Whereas in the past, what we've been sold by influencers or institutions or anyone with a platform is this Metcalfe's law rule of network effects on L1s, and how blockchains have this kind of special property where you're able to scale based on the number of users. This should create more transaction fees, build a more resilient kind of overall blockchain that is worth a lot. The pendulum has shifted so far away from that, away from any optimism in this kind of bearish phase, towards this like, what's your 24-hour fees and revenue on DeFi Llama? What does that look like? And then how can we kind of like make a valuation game based on that? And so I kind of think the pendulum will kind of shift back towards more somewhere in the middle, where like revenue is welcomed, but also we're understanding that we're very early in kind of like this liquid venture type of investing. So to put you on the spot a bit here, Canton Network, I think, is trading around 3 to 4 billion in that kind of range.
It's 5.5.
5.5. Thanks for correcting me. Why is Canton worth 5.5 billion?
No, it's like really fucking low right now. It's crazy.
Okay.
Yo, you don't think so? I mean, look at the multiples on fees that some of these other ecosystems are getting.
Yeah.
Okay, let me build it. Let me build a story from like first
I love
principles.
the bullishness. No.
Please. I don't know that the pendulum is going to swing back all that much, because you have an audience coming in that's just a lot more thoughtful, and they're going to make longer term decisions. Like the idea of just kind of these waves of retail coming in and out and letting people out of their liquidity. They've been taught the lesson too many times that that's not going to work out for them.
Yeah.
Right. So I think that what you're similar to your liquid venture statement, imagine if you're going and raising money in the Valley, you have to make like a credible business argument, even if it's early. Here's what I do. Here's the problem that I solve. Here's how I'm going to capture some portion of that value that I solve. And you're going to get graded on every round through some progression of those metrics, and they may evolve, but the metrics get harder and harder as you go up the value chain, right? They don't get easier.
Yeah.
So I don't really anticipate that if we think that the value of these worlds are going to expand, whether because they're facilitating higher value things or because the tokens themselves are more valuable, that you won't be held to a higher standard as we go. So I actually think it's more likely that the pendulum hasn't swung far enough, honestly.
I like it.
And then, in terms of like, how did we do this? I mean, we launched, Foundation in the US, Pete Gensler hunting heads, digital asset, headquartered in New York City. We have publicly traded financial institutions that were part of the launch. They had never held crypto before. It's on their balance sheet. We wanted that. Like, we wanted to be an ecosystem that was eligible for people. And one of the things that we said is, well, can I do like a discounted cash flow analysis on the value of the token?
Mm-hmm.
What would I have to design to make that possible? And I think that being able to map how what happens in the ecosystem directly translates into value of the token. If you don't have a really strong story about that, then I don't think you really have a story at all. So I actually think that the pendulum hasn't gone far enough. And then, in that regard, there are two things that we really focus on in the network when we think about the success of the ecosystem. And we are not a company. It's not centralized. It's not run by a couple entities. It is truly a decentralized ecosystem. But if you were to think about it like you would a publicly traded company, you would kind of care about roughly two things. You would care about revenues, top line revenues, and that they're growing, right? So for us, that's burn in the network. Fees, every dollar of fees is burned. So that's a one-to-one relationship. That's automatic. That's in the protocol. There's no discretion. Every single time someone uses the network and it has fees, those fees are burned. So that is like a baked in sort of thing. So we're always trying to grow fees or burn, period. And then just like any other company, you would say, well, what's the quality of this revenue? Are you, does it have positive margins? Do you have high churn? There are many different ways to think about the quality of revenue. But one of the ones that we're really focused on are like the durability of the things that are driving the fees, right? To pick two extremes, if one is meme coin trading, which we expect to come and go with fads and, be hotter than shit and then disappear at some point in time, it's not very durable, right? We don't really know what the long-term, high water sustained mark of activity in that is. On the complete opposite end of the spectrum, payroll is insanely durable. Maybe there are more companies, maybe there are more employees or less, but that shit happens without failure, right? Bank financing happens without failure. Repo happens without failure because that's part of that bank financing. So we are trying to be as deep into that inelastic side of the curve or that durable side of the curve as we can be. Are we 100% there? No, we're not. We're still, somewhere in between the two. But that is our constant drive and focus, is to push the quality of that burn as far to the right in that spectrum as possible. The reason is that you should get better multiples on fees the further into the durability side of the curve that you are, right? And right now, when you look at these other ecosystems, they're getting insane multiples on fees that don't even translate to value to the token holder.
Call them out. Who?
I'm not going to fucking
Call
name
them
the
out,
names.
Eric.
I'm not going to name the names because they don't have burn mechanics that are, you're double dipping. Validators get the emissions and the fees. That's double dipping. That's a classic example of a Bitcoin design decision that leaked into the other ecosystems that doesn't belong. Right? If I have permanent emissions and I have fees that go to the validators, that's double dipping.
Well, then you just can't count the validator emissions as any sort of protocol revenue. That's just inflation.
No, I
That's
understand,
not
but I just
revenue.
mean part of the speed run to zero fees in a lot of these networks is that there's no structural reason for the fees to exist. Like if you got rid of fees in one of these top 10 networks that don't have burn, the validators are still going to be there.
And are the fees that are generated on Canton's network, is it primarily paying like the equivalent of a gas fee, trying to get settlement onto a shared block space, or is it something that's a little bit different because you guys are coordinating transactions amongst institutions with durable
It's any
businesses?
update. Any update on the chain generates fees. And we've set the price pretty high. I think it's expensive right now, honestly, because I think that this like speed run to negative, fees is nuts. I think that it's not really thinking about the long term. But one really important thing about the fees in the network is that they are not paid to the validators.
Right.
They are paid to the app that you're interacting with. It's kind of like interchange. So, if the minimum fee in the network were a high number and your use case meant that that was an untenable thing, well, the app that you're using could choose to pass through its revenues to offset some of your costs, right? Like think about the way interchange works. You use your credit card, generates a lot of fees, you're getting points or cash back, and it's a very competitive market as people think about how to play with that margin for customer acquisition cost and how to balance their margins versus CAC, right? So the fees in the network go to the apps in the network, which is a fundamental, I think, mistake of the other ecosystems.
All the other incentives are primarily going for the validators to upkeep the network. But so then,
It's overweight.
right?
It's overweight.
And we've had some of our most viral moments on this show talking about how staking rewards are overinflated,
Insane.
Overpaying for security. There is some sort of minimal viable.
Sure.
What is that incentive in the Canton network to incentivize validators to participate?
Yeah, and maybe
and
talk
secure
about the
network?
kind of termination of that program with the validators upcoming, I believe, the end of the month or.
Yeah. So the original design of the network is that the only sort of like permanent emissions that go for not really doing anything other than providing infrastructure goes to what's called the super validators. All the validator and the app rewards are earned pro rata to your activity in the network.
Yep.
But because we did a completely fair launch, we did 0 tokens at the beginning, no pre-mine, no pre-sale, nobody had anything. If your rewards are generated based on using the network, you're not listed anywhere yet because I couldn't go give 5% of the float to an exchange to get listed. And I can't buy them on the market. Like, how do I use the thing? So we had a bootstrapping issue. And so into all the validators, we added an emissions element to it to help this initial sort of bootstrapping.
Yep.
And it was the remainder of, if there is activity rewards, if there's anything left, pro rata distribute that to the infrastructure that exists.
So it was effectively like a block reward, similar to Bitcoin.
That's right. And when listing happened and there was sufficient distribution of inventory into the market, so people could buy it on just about any major exchange on earth, and there was a broad distribution of it already, there's no need to continue to just distribute
The block rewards.
the block rewards to
It's
those
got
entities.
significant
And especially since there's already this other reward mechanism designed in there, which is all around activity in the network. Right. So if you're an active validator in the network, you're making significant, returns from a rewards perspective. But there was no need to have this incremental block reward. So that's what's been phased out.
Yeah.
So we're just going to back to the original white paper structure of all this stuff. Like I said, we've learned through, hard lessons learned. There's not a lot of people that have gone down the path that we have.
Yep.
And so we've bumped into some realities along the way that the thing I'm most proud about our community is that it is insanely proactive about making changes. And we have so the foundation is like an open governance thing. Anybody on earth can join it. If you guys wanted to join the foundation, I would love to have you.
There you go.
You honestly can join. It's structured the same way that like the Linux Foundation is. So there's a membership fee, but you guys are less than a few thousand people. So your membership fee would be very reasonable.
There you go.
And you can then participate weekly. There is a tech and ops call. There are marketing calls. There's a tokenomics review. There's so many things. In the weekly tokenomics meeting, we sometimes have 150 organizations show up.
Wow.
I can't remember the last time we had less than 100
Nice.
that was there. And it is a lively, active conversation. We cover a lot of ground. We discuss a lot of contentious things. And, then we actively vote on these things and make adjustments as we go. And I think that that's a very important part of a lively, thriving ecosystem is that you can see we intended A, we got Z, should we try something different? And I think that if you don't acknowledge that it is a bit of a living organism and that you don't have the right machinery in place to adjust that organism in a fair, truly like open way across a bunch of different participants, then it's very hard to actually accomplish your goals.
So I was going to ask the question if you would expect some validators to drop off since that subsidy is no longer being
absolutely.
But I'd imagine that, at over 100 people, joining these calls, these, 100 plus organizations joining, you're comfortable with, the amount that is going to continue and the people that are going to drop off
We
you won't
announced
struggle
this,
for validators.
if I remember correctly, I think this got approved before the end of the year. And I think we're 2 of 3 step downs into the process so far. We still have a waiting list in excess of 1,000 validators to join the network.
Very cool.
And when I say waiting list, like a lot of people, maybe just to touch on one fairly fun thing for people. Oh, it's a permission to blah, blah. It's not. It's just rate limited. We're just trying to do responsible growth. There's no one's getting KYC. No one's getting put through the ringer. It's just, okay, you fill out a form online, you get prioritized against anyone else. You know how you get to the top of the list? You're on testnet, you're ready to go.
Yep.
That's like the number one criteria. Is your node actually running? You know what you're doing, you're ready to go, you have something to do? Cool. You're on the top of the list. Like it's not really very scientific.
Right.
Yeah.
And it speaks to the amount of fees that you guys have flowing through the network now that people aren't going to drop off and they're no longer getting the subsidies. It means that you guys are generating significant fees to incentivize validators to continue joining the list. One of the primary sources of fees that I'd imagine, you mentioned them earlier, the repo market. You guys are doing, there's some varying numbers here, but as of December 2025, $384 billion per day, maybe more or less now, but on the scale of hundreds of billions of dollars per day via this partnership with Broadridge, this distributed ledger repo program.
Yeah.
$384 billion per day. What does that roughly equate to in terms of fees? And generally, I'd love to understand more about how you've been able to bootstrap this repo program via Canton.
Like maybe just give us a bit of an education on what's happening first.
You're not going to expect this answer.
Okay.
Zero
fees.
So it is not
Oh my gosh.
currently doing anything through the mainnet. It will, okay, but they've been in production for probably going on 6 years.
Yeah.
And one of the cool things about Canton is that it's this unlimited horizontal scalability ecosystem. And what's different about Canton versus, we've seen a few iterations of that in the past. Again, I'm not going to pick on anyone because I think that conceptually they're all very, very in the right direction, but execution, they didn't hit it. The big delta is that we have global composability across all these subnets. So no bridging, right? Like think about your experience on the internet. I've got one browser, I hit N websites. Right, that's really the way that Canton works. I don't need a node for that subnet. I don't need a wallet that works with that subnet. I have a wallet. I hit N apps in the ecosystem. If I want to compose a bond at Goldman into a repo transaction at Broadridge, I can do that. That happens over the global synchronizer. Those things are coming. So we're hitting these fees before we've even put these large-scale institutional things in some attach rate over the global synchronizer. The thing that will draw that into composing over the global synchronizer is the cache leg. So today, the cache leg on that whole use case goes Fed, off-chain. So it's the security, it's the workflow, it's the prep, it's all that sort of stuff. It has material benefits for people before we even include the cache leg to it.
When you say goes Fed, you mean like the money
wire transfer.
Okay, so that's all that's happening.
Yeah.
But a lot of the operations is taking place on chain?
Trade confirms, the scheduling, the asset itself, right? The settlement of the asset itself, all of that is all on chain. But the cache leg is still going Fedwire.
Okay.
Because stables today, we're just starting to get guidance that you can use them in capital markets context without massive balance sheet hits, but it wasn't true for a long time. Right. And so even then, after that guidance, I think there'll still be some blockers to it. But that's why I'm so excited about stuff like JP Coin and all that stuff going live, because I think that's where you'll start to really see intraday repo, weekend repo. And I don't know if you've been following all the pilots we've been doing, but doing a repo on a Saturday morning for 2 hours is going to be incredible.
Yeah.
Like the amount of adoption we're going to get for that sort of
Could
stuff.
you tell us, like, what are some of the knock-on effects of that? We've talked high level about how this, lower settlement times, lower custody risk, counterparty risk. Ultimately, that's, money saved, money earned, greater liquidity. You can move this money faster, higher capital velocity. Like
specifically around like reserve management, right?
Yeah.
And like the change in the structure that these firms are going to have to undergo as a result. Like, what does that actually
what kind of
look like?
value does it unlock?
I'll give you a few examples, and I'll try to kind of jump on both sides of the aisle. So let's start with, I think your audience is probably a little bit more crypto native. So, I don't know that a lot of people realize this, but you can't at scale create or redeem USDC off hours outside of Fedwire hours. We used to be able to, but with the death of, I can't remember if it was Signet or Silvergate. I can't remember which one was the real backbone to a lot of this. But the creation and redemption of USDC on a Saturday at scale, unless you co-bank with them, is very, very, very difficult. Now, what that means is if you're a large liquidity provider or a venue, like an exchange, you have to carry what you guess your liabilities or working capital needs are going to be every day after the Fed closes and every weekend. I don't know if you guys remember, but Trump coin went nuts off Fedwire hours, and the market literally didn't have enough stablecoin liquidity to trade it. There's like a really great article, I forget where it was published, but I think Galaxy was lending billions of dollars of stable coins to liquidity providers because they happened to have had the excess, in that off hours, and they were delivering them to people to be able to do it. So this is material. It might be a half yard or a yard, it's $500 million to $1 billion every night, every weekend. In the best case scenario, you didn't need that much and you lose some interest. The worst case scenario is you miss the trade because you don't have enough working capital, right? The returns on trades are way better than the interest on a risk-free bond, right?
Correct.
So the worst case scenario is you need the money, you can't mint the money, right? But once you have a 24/7 repo facility, I can sit in a treasury 100% of the time, and I can deliver it to the issuer at any size and get stables minted from scratch, use them, and return them, and pay for 6 hours of interest if that's how long I needed the working capital for, right? And that's true in crypto markets. That's true in capital markets. If you're talking about payments use cases, do you know how much pre-funding in the world is just kind of pre-placed into different locations?
That was going to be my question. Is so teams or treasuries are overcompensating with how much cash they might need over the weekend because they know that they can't get it.
Every form of business does this.
Yeah.
You do this in your personal life.
Yeah.
Why isn't every single penny of your PA invested 100% of the time?
Into Canton.
Well, because because maybe you're going to go out at night and you need some cash. Well, you can't draw off your money market fund, right? And you're not going to pay the 42.5% interest charge to borrow cash against your credit card or whatever it is. Right. So like you sit over allocated into cash at all times. But if you could guarantee that I'm in a risk-free overnight rate, and at any time, I could materialize that into the form of cash that I need.
Correct.
Because it might be a deposit, it might be a credit card payment, it might be cash, it might be a stable coin. So it's really any form of cash that you need. Then that becomes like a very interesting optimization to do. And for us, maybe that's not going to make the difference between a 2-bedroom and a 3-bedroom apartment for us. But for an international corporate that's doing this in 152 jurisdictions around the world, this is a material number.
Yeah. So Eric, this is a good kind of segue into, let's just talk about the size of this operation here. So if Canton is to succeed in its vision and mission, I think the repo market is doing 10 to 12 trillion dollars a day in total. So that's one market. But just give us a sense of how big this, like the broad TAM of something like Canton really is. Like, let's think about the repo market, the kind of treasury market, the equities market.
You mentioned bank financing, payroll, durable mechanisms.
Like, how big are we talking here as far as like we're just scratching the surface of bringing this type of activity on chain? And then maybe just walk us through like what you see as the evolution of making that slowly chipping away at those percentiles.
I think that the number that I would say is like a ludicrous number, right? And an argument I've been making with a lot of you mentioned DeFi Llama before, but with these types of institutions is that the way they've structured their reporting is it's all like knives out, like, oh, I'm doing better than you. Instead of like arms together, how much of the world's GDP have we rotated on chain? And I think it should be a joint mission for everybody to be rotating as much of the world's GDP on chain as we possibly can.
Yeah.
And so right now it's measured in probably sub basis points of the world GDP that's online. And we should be in the percentage points in the next, couple, 2 to 3 years. That would be an astronomical change to the world if we manage to pull that off. I don't think you'll ever get to 100%, just as like, I don't even think we have really 100% of finance on the internet today, so I'm not sure that number is ever going to be bigger than 15, 20%. But even if you got to 2%, it would make a material difference in the world. And then, to your question about like, what's the path, when you have a TAM that's that big, the biggest problem is that you start to lose some focus. You could kind of go after anything and everything and then accomplish nothing whatsoever. And so for us, I try to keep this as tight as possible in our go-to-market motion. In every market, I want 4 things plus 1. So the 4 things are, I want the short duration government bonds in every location. I want the commercial bank deposits in every location. I want the stable coins in every location, and I want the repo and spot bond markets. And not just individually, but all of them working together seamlessly so that I could go in and out of any one of those things as a lending transaction or a spot transaction at any time of the day. Now, if I have that in 2 jurisdictions, I now have a very interesting international settlement market. I could do a US government versus gilt settlement at scale because the bond markets are very deep. And if that happened to have been part of an FX settlement, someone could go into a commercial bank deposit. If it happened to be part of, permissionless payment, someone could go into a stable coin. Like whatever that may be, I think you start to completely rewire the international capital market system with those 4 things. In addition, I think you also want the equities markets because it's just an obvious sort of where are people directing a lot of their money part of the equation, but it's not necessarily an enabler of the other four. Like those other four build upon each other.
Yep.
So equities is still incredibly important because it's a massive sort of wealth draw, but it's not the same as the other. But the equities market has very, very similar characteristics. The lending market's very important, not just the spot market.
Yep.
You know, the creation redemption market for when you talk about like ETFs or baskets or structured products. So it has almost the exact same dynamics. And they all play off of each other in very interesting ways.
Yep.
But it's not necessarily the same sort of like international commerce enabler that getting the cash movement around the world correct would kind of do. So largely bonds and cash of, you know, kind of every form and their fungibility, and then the most obvious asset class that you would, you know, go in and out of with that cash.
What does the fee landscape look like when you're primarily dealing with some of these, you know, cash assets or bonds? These are doing tremendous amounts of volume on a very frequent basis, but they're accustomed to relatively low fees.
Who are?
Maybe I might be getting that. Yeah. So I'm well, let me just, I guess I'll frame it in terms of a question. Like, what is the current landscape of fees? What are they accustomed to charging now and paying now?
Yeah.
I guess is the right question. And then where can that go with Canton?
I mean, things are calculated in basis points, generally speaking, in finance, right? I mean, it's very rare with the exceptions of like Swift infrastructure or, you know, sometimes in the exchanges, trade infrastructure, that you're paying like a flat rate a message.
Got it.
Right. But generally speaking, the moment you get off the infrastructure, you're in BIPS land.
Yeah.
Right. So I think that really where Canton stands as a direct alternative is to the existing messaging infrastructure that we have that plumbs all these things together. And, you know, there I think the long-term opportunity is for us to figure out sort of unit economic exchanges for like if you think about the current price to use Canton network, think of it as like the peak variable rate. And we'll figure out ways to do kind of like unit economics in exchange for removing variance.
Yep.
I would anticipate we'll figure stuff out along those lines. We're having a bunch of conversations, but it's too early to like say that we know exactly how that's going to work.
Yeah, Eric, as we kind of come to a close here, just speaking to the Canton community at large, token holders, the validator network, the team, the ecosystem, what's next? What is the, you know, we just talked about what that kind of cracking down on bips by bips to get the 10, 15, 20% of assets on chain in those four categories. That's going to take obviously a while. This year, 2026, you know, first half of the year, what are we looking at?
First half of the year in the United States, we will have all four.
Boom.
All four in production. And the second half of the year, we will have them in various forms and at greater fidelities of production. Beauty. This stuff is happening right now.
Beauty.
Eric, my last question for you is, you know, Canton was a fair launch. Like what, how are you personally, like, I'm sure you have a bag, right? You must.
I don't. I actually don't.
So like, how
you
do
don't
you
own any Canton tokens?
All the Canton coins that I have, I've purchased on the open market.
Okay.
got it right? Okay.
I mean,
all
I have
the
equity
Canton that you've purchased are on the open market.
I've heard this from other Canton
So
members as well.
I have equity in Digital Asset. I'm a founder of Digital Asset.
Right,
Digital
okay.
Asset has tokens, but it's a part of DA's balance sheet. It's not like it's in my wallet.
Right.
Okay.
Right. I have the same claim to that I would any cash or distributions that the company would make to all shareholders. And any Canton coin, and I know this to be true for every other employee of Digital Asset, they've purchased on the market.
There you go.
I mean, I've got an open plea out to people in the ecosystem to build me agentic TWAP bots so that I could just buy every like 30 seconds for the next 100 days, you know, stuff like that. Like, because I really don't ever want to get caught in a situation where it's like, I'm working with so many companies to help them go live. What's insider information? Like, it's terrifying to me.
No, of course.
So just, okay, how do I take all decision making out of it? Just do a massive, long-term, constant, continuous TWAP. You know, that sort of stuff is kind of where my personal interest is on this. And yeah, absolutely, I'm moving my balance sheet into it. And we're doing everything I can for me to get paid on chain, for me to rotate all of my investments on chain, all the things that I automatically do with all my cash, directing on chain, anything that's like in any way comparable to the dividends that I get, I am the first in line to participate. So yeah, I mean, we're trying to do everything that we can to eat our own dog food.
Practice what you preach. Eric, thanks so much for coming on, man.
Thanks for coming on.
Absolutely.
First guest in the
that's awesome.
Live from the
guest in
nest.
studio.
Yes,
Thanks
super.
for joining, guys. That wraps us up for today. First guest in the studio live from the Tokenization Tower, powered by Plume. Ladies and gentlemen, we'll see you guys tomorrow. Thanks for joining.